morning, good afternoon. Thanks for joining us today. We have an update with Terry Harbort, CEO of Talisker Resources. Talisker trades on the TSX under the ticker TSK. It's been a while since we've had an update, so lots of important news flows happened over the last couple months. Terry's actually taking the call from site, so get a full update there. I think for the purpose of this session, we're just going to do Q&A. We got quite a few questions in advance from shareholders, as well as we have some of our own. So if you're participating, you'd like to ask a question, please feel free to put it in the Q&A box at the bottom. With that out of the way, I'd like to introduce Terry Harbort, CEO of Talisker. Hi, Terry.
Hi, Deborah. Thanks very much. And welcome to everybody from Bralorne.
Yeah, exciting times.
Yes, it certainly is. Good to see things moving along. A lot of people around and coming in as our team comes together in preparation to begin production here.
Right. Well, I guess we'll get started with Q&A. I think Magda is going to kick things off.
So we've got some technical questions to start off. So the first one we got from the audience is, can you speak a little bit about when production or making money can be expected to start?
Okay, what I might do is pop up the recent update of the corporate presentation, and we can talk in what the timeline is to make it to that all important cash flow. Here's basically the timeline that we're looking at. We're currently in the mobilisation of the mining crews, bringing the team in. So that's additional cross-ship senior engineers, geotechs, mine shift bosses, trucks and loaders and things coming on and coming in. Once the entire mining crew's here and been trained up on the emergency rescue plans, they'll start the re-establishment of services. That's water, compressed air and electricity underground, and also ventilation installation. So anyone who's been to an underground mine has seen that, the big bags that go across the backs or the roof of the tunnels that provide air and ventilation. Once all that's in, then the development will start. And what we start is with in-vein development. So we're using a mining method called long hole mining. So we develop our access along the vein itself at a larger size or width than the mine. So we're developing that at 3 by 3 meters. I think we had a question there as to whether some of that's could be ore. It depends on the assays as we're mining it. And the level of dilution from that extra bit that makes up the 3 metre mining width. So we're hopeful, particularly in the high grade zones, that will remain above our cutoff. Once that access is completed, and I can jump to an image of our development, then we start our first production, which is at 1.8 metres. So that's going up from that development. And then we can start first building an ore pile at site, and then once we have enough, start trucking that material to the offsite milling site, and then milling of that material. That'll come somewhere in early Q2. At this stage, we're looking at sort of April to May, and then our cash flow will be a couple of months after that. The reasoning the cash flows after that is because we're toll milling, so we'll deliver our material. It'll get processed, and we'll either have a gravity and a sulfide concentrate that'll get on-sold to a smelter, or a doré product, which is a melted down or a rough gold bar that'll have gold and silver in it. And then once that is delivered to the wharf and on its way to the smelter, we'll get a percentage paid there. Generally, it's about 70%. And then the final true-up, the final 30%, will come in after the smelter assays. So that's basically the timeline till we hit that cash flow. Or I'll just pop this down and we can jump to the next question.
Thank you. And then we had a question come in, I think it was this morning, about scaling. And can you talk a little a little bit about the trucking and the toll milling strategy, and specifically at what point does it get difficult to scale?
So just to break down how that works, basically we truck material up from underground that we've mined. That material we have a estimated value that's based on our resource model. So that gets deposited on surface. We then sample that material, or muck that it's called. And we also have face samples that we've developed along the faces. We assay that material. Once we get the assays back, which takes a day or two, we then classify that material into ore or waste, and then that material gets loaded onto the trucks. The trucks in general can carry 40 to 50 tonnes of material. So at our current rate, sort of up to 170 tonnes per day, we're looking at trucks. When does that start to become prohibitive? Well, we are operating on public roads, so we can run a large number of trucks. However, we are very thoughtful of our community members that have to listen to the trucks running past on those highways. So I think at this stage, we'd want to keep it to below 10 trucks, which is in the range of 400 or 500 tonnes per day.
Okay, got it. And apologies, Terry, I think you cut out for a minute, right, where you were saying the number of trucks before the 10. What was the number you're saying we're running to keep it under?
Under 8 to 10 trucks.
Okay, got it. Thank you. And then that kind of leads into the next question that someone sent in. Can you talk about the time frame you might consider towards an on-site mill?
Sure. The main constraints that we have for an on-site mill is available capital. If we had tons of capital, or we wanted to go out and get debt for that, then we could certainly start that process now. The expectation is it'd be about a 3-year time period that we'd be trucking material, and that'd serve multiple purposes. Firstly, that time period would assist us in upgrading the power, the electricity that had come in to operate that mill. Secondly, our permit amendment requirements. So we'd have to increase our waste management plan, have to increase our tailings management plan. At this stage, we'd look to change the style of tailings. Instead of having wet tailings in a dam, we'd look at a filtered or a dry stack. And we'd also look at underground paste management of tailings. So all of that would come into that plan, and that combined with the increased rate would go into the permit amendment. At this stage, the expectation is anywhere between 18 months or 18 months to be able to do all the engineering work and then come up with that permit amendment. And then the third thing is to be able to generate and put away a war chest to pay for that. So by third year, we're in very strong cash flow. So we can use that cash flow then to start to implement that mill either partially or fully.
Got it. Thank you. And then we had another investor also asking about capital allocation for the mill, who's kind of worried that this could be a big dilutive event, and kind of, can you walk through your thoughts on allocating that capital?
Sure. At this stage, with a fully operational mine, I think we'd move away from equity pathways, so selling shares or doing private placements to raise those quantums of capital. We'd most likely look at some debt instruments or pre-sale of material to be able to fund those constructions. It's very rare that mines going into production use equity fully to be able to bring their infrastructure in. Mainly because of that purpose, it's dilutive, and there is better availability of other instruments that you can pay back using cash flow.
Okay, Got it. And what are your ideas on what you would do with profits? Pay dividends, things like that?
Magda, at this stage, I think all of our capital would go back into growing the company. I think it's probably too early in our corporate lifestyle to be paying dividends out. And we can certainly do a lot better by growing the resource, increasing the production rate, and producing more gold. I think that's the best pathway there. We want to grow the company as fast as we can, and it'd be better to put that company back into that growth.
Got it. Thank you. And then, excuse me, given the modest capex and exploration costs to date at Bralorne, Talisker would generate world-class returns on invested capital in 2026. So the investor here is asking, could you use free cash flow to prevent dilution from any potential convertible debt?
Yes, absolutely. That's certainly what our plan is, and that's why those convertible instruments were, while the conditions were set up for us to be able to choose to pay back at a longer time frame without having to have them converted. Yeah, that's certainly why we did it.
Okay. And then touching on infrastructure, are there plans to expand infrastructure such as milling agreements or transportation systems to support higher production volumes?
We're certainly constantly looking at different milling opportunities, whether it's a better deal economically, whether it's closer, reducing transport costs, whether the mills have got higher capacity, whether we get better recoveries and better quality of product out. So yes, we're constantly looking at that, and we're actively working on multiple agreements associated with that at this stage. As far as trucking goes, I think we really have the optimal trucking arrangement at the moment because we're road trucking. We are constrained by the size or the volume of the trucks that we can use. So I think that's already fairly well optimized.
Okay. And touching on scalability, so scalability of high-grade zones, how would scaling plans leverage the continuity or the high-grade continuity and the structural continuity of the Bralorne veins?
Yeah, interesting question. I'd have to say that the way the deposits form with an echelon veins, so veins that run in parallel to one another, combines with the continuity to make it a relatively easy project to mine. As we're using long hole development, which develops access along the veins, I think it's already fairly optimized for this style of deposit. Obviously, where we have areas where we have a large number of veins, for instance, when we transition to Bralorne West, we've got 5 veins that are in close proximity to one another. And further away between Bralorne and Pioneer in what we call the BP Gap, we have areas where there are 8 veins that are in close proximity to each other. So I think that's probably the main opportunity there to increase that production rate and increase that scalability potentially beyond what we're looking at here. The other opportunities that could be applied are in increasing the mining or the access size. So that's increasing, for instance, the long hole development from 3x3 to 4x3. So you can use more automated machinery such as jumbos. You can get larger equipment in there to move more material, larger ramps or portals. At the moment, we're looking at 4x4, but if you had 5x5, you could move a lot more material and get better economies of scale. It just depends on the amount of dilution and the change in the grade and what the trade-off is between those changes relative to your decrease in production cost.
Okay. Got it. And then touching on operational challenges as you're looking to scale, what potential challenges do you anticipate in scaling operations, and how are you mitigating these risks?
I guess at this stage, we don't see any potential challenges with a scale up to 750 tonnes per day. We have enough access planned and developed there, and it's all quite an engineering equation there to do production rate, backfill rate, number of trucks, number of people, number of crews. I guess where the real scale-up comes is if we look in the future to go beyond that 750 to potentially, let's say we want to double that by having an additional portal access. Many people will be aware that there's about a 5.5 kilometre strike length along the Bralorne deposit itself. There's existing historic accesses, portals into those areas. And we're certainly looking here at our long-term plan of being able to develop those, slash them out and give us good access. So really, we'd look at having several accesses and really operate those as not quite independent mines, but certainly mines that have similar infrastructure. So that's sort of the way that we're looking at how do we increase production from our currently planned ramp up to 750.
Okay, thank you. And then touching on exploration, how would ongoing exploration efforts contribute to sustaining and scaling production beyond initial targets?
Right. So in general, operating vein mines such as Bralorne, you have a 2 or 3 year worth of resource that's in an M&I category. Some of that prior to production will get converted into proven and probable internally, and that's certainly what we've done with our development along the veins with Longhole. And then really your exploration needs to be staged out to replace your production. So if we're producing 80 or 100,000 ounces per year, then we need to be able to drill enough material to replace that and grow it on. And in general, we're developing exploration targets, converting those into inferred resource, converting inferred into indicated resource that can then get built into the mine plan. So it's a fairly systematic exercise, particularly here with Bralorne. We know what a great deal of the of where the historic veins are. Many of these have got channel samples on them. So being able to discover or find new veins is not really the objective. We know where a lot of them are. It's drilling to convert them into resource categories that can support mining.
Got it. Thank you. And can you walk us through the initial plan for when mining starts? Would you mine one stope at a time, or would that increase with the planned acceleration and development later this year?
Perhaps I could try to run through a video that Hugh Borden, our senior mine engineers, put together for us that really shows the development over time, and people can see where that is, where we develop along veins, where we develop up into the stopes. So I'll have a go at showing that, Magda. If it doesn't work well, let me know, and I'll move to showing it with maps.
Okay, thank you.
Okay, so hopefully everybody can see some mine workings with a black background. Okay.
Yep, looks good.
So we'll just run through this. We'll start off to position everyone. We're in the gap between the Bralorne mine, which sits here on the right, and the King mine, which sits over further to the left. And we're sitting in what's known the Bralorne Pioneer Gap, where we have significant resource. And almost in the middle is the Mustang area, where we've developed the decline and developed the portal. And that's where we're looking at starting production. So you'll see the blues development along the veins or ramp development, and the green areas are development of the stopes. So you can see here in the first couple of years, we're focused here on Mustang on the left-hand side, and then we develop across to Bralorne West. In Bralorne West, we've got 5 ore bodies that we'll look to mine there throughout the time frame. So initially this year, we just focused here on Mustang, and then we start the development to crank things up into Bralorne West. And really then the focus transitions across to Bralorne West. As you'll see, we do continue development at depth as an auxiliary production at Mustang to the left, but most of the production comes out of the veins here at Bralorne West. You can see the scale of those. They're about 500 metres long continuously, and we mine them at least down to about 600 or so metres. So there's a large number of ore bodies there and a significant amount of gold that we develop out.
Got it. Thank you. And can you remind us again quickly of the cost per ounce? What's the cost to truck and toll mill?
Would you like that in per ton? I have it very easily, or I can calculate it per ounce. Per ton, we're looking in the mid-80s, about $85 to truck, and our tolling, depending on where we send it, is sort of around the $100 to $130 mark.
Okay, thank you.
If we look at some of the more distal projects, or distal mills, the trucking rate increases, but the milling rate decreases. So it works out to be about the same combined around the $230 per ton.
Okay. Thank you. And just wrapping up on the technical questions, what drilling is planned for 2025? Do you have an estimate of meters planned?
Yes, the team's just working on that. It's approximately 500 metres from underground, which will basically pinpoint some of the remaining stopes from year one that we need to convert. And the remaining is about 3,500 that'll be drilled from surface. So relatively small drill program, about 4,000 metres in total.
All right, thank you. And then Deborah has a whole bunch more audience questions for you.
Yeah, there's a couple about officers and directors, so maybe we'll start there. Can you walk us through the skill set of your board of directors and how they add value to the company? Sure
thing. I'll start with a few of the members on the technical committee. The chairman of the technical committee is Eric Tremblay. Eric Tremblay is a mining engineer. He originally was a shaft sinker before he became a mining engineer and worked for an extensive period of time with Agnico Eagle, and then went and studied mining engineering and finished that off and completed that. He's most probably well known for working as the mine manager at Canadian Malartic, which is still, I think, Canada's largest gold mine. Post that, he worked at Dalredian on the Carrignal deposit, very similar to the Bralorne deposit in Northern Ireland. He had the position of COO there and led that through the feasibility. And I think recently he's just finalised the feasibility on the Caribou deposit with the Cisco development. So a lot of great support there from Eric. And then Christy Smith, also one of our directors. Christy Smith works for Falkirk, which is an environmental and First Nation engagement consulting group. Christy's got a Master's in Indigenous Engagement and an MBA, and she's also worked a lot in ESG-based roles, working particularly with health and safety, community engagement, and First Nation engagement. So she's got a wealth of experience there that helps us right across the board from the permitting side through community and First Nation engagement, and also reviewing of health and safety strategy. Others on the board, is this specifically relative to Bralorne and mining, or? Sorry, I forgot the detail of the question.
It was just, can you walk us through the skill set of your board and directors and how they add value to the company? So it's pretty general, Terry. I think you can take it in any direction.
I'll add the rest of them. Steve Burlington, who's head of the audit committee, Any investors in GT Gold will know Steve Burlington. He was the CEO there who negotiated the acquisition of that with Newmont several years ago. Steve's an investment banker and brings a wealth of knowledge on capital and or any sort of financing that we need to conduct and operate through. Next to mention is Rob Power. Rob Power is a former lawyer and now is CEO of a mining company in the US, in Alaska. Has a lot of experience again in both Canadian and US and Asian markets, and also a lot of experience with M&A and activity. And then finally, our chairman, Morris. Morris has been around the block for a long time. He's currently a fund manager and also has a lot of experience on the boards over the last 40 years, having sat on multiple boards and being involved in multiple companies that have gone through the pathway we have from exploration through to production.
Great. And then there was another question just asking which directors and officers have participated in financings over the past 3 years.
Over the last 3 years, I would say, to my knowledge, myself. Of course, I've put several $1 million and a considerable amount of my net worth into the company. Morris as well, and he's almost participated in just about all of the placements that we've conducted, either personally or through his fund, and Eric Tremblay as well. The other 3 directors are relatively new directors. They've only been with us for a little over a year. So we haven't done a great deal of capital raising across that time, so they haven't participated.
Another question that was sent in earlier. So from an investor, you were able to fast track the development of the Bralorne complex in large part due to it being a past producing mining operation with most of the required permitting and infrastructure in place at purchase. In the meantime, your long-term investors have been nearly wiped out and have little chance of making their money back, never mind a small profit. So 2 questions related to that. What do you say to the retail investors who watched your advertising on BNN years ago, invested in your story, and now are looking at losses of up to 80%?
Okay, I'll
deal with
answer
that
one first, because I think that deserves a very solid answer. Look, I think we're all pretty aware that the junior mining, particularly the gold junior miners, are in the worst downturn since Bre-X. So I think it's important for that retail shareholder to have a look at the rest of the market, not just have a look at us. Have a look at what all of the junior companies have gone through. Have a look at the challenges that they've all faced in raising capital to keep the lights on, and how many companies have actually gone to the wall, have actually gone bankrupt throughout this time, because really the money has gone away. And I don't know how old that investor is, if they went through Bre-X and .com, but it was very similar. The big difference is that the gold price was $250 an ounce, not $2,500 an ounce. So I feel his pain, because I've invested in this company all the way along on all of these private placements, and it's my net worth, it's my retirement money that has gone into this. Now, the question I might pose back to that retail investor is, how much money have you put into growing the company? Or have you just been buying and selling shares on? Because the rest of us have put money into growing this company. And what's important for us is to be able to build an asset, grow back and accrete back to the size that we believe this company's worth. And we know across the board, most junior miners, they're being valued at about $10 an ounce. Now, it costs us $40 to $45 to drill that. So there's something fundamentally wrong with the market and fundamentally wrong with the support that the market gives us as junior explorers. And that's why very few companies are drilling and putting out drill results, because those that can raise money, the market doesn't pay them back with valuations for the ounces they put on the books. And we've followed that path. We've delivered absolutely everything that we have said we were going to deliver. The resource, the volume of drilling, the royalty sales and funding to get into production, with the ore sale and toll milling agreements, First Nation bridging agreement, everything that we have told we would deliver, we have delivered. And the market doesn't pay back for it. And I'm not going to gripe, because I understand that so many of our peers, almost all of our peers, there's a few exceptions, but the vast majority of us are in the same boat, because all of the interest has gone away from the junior mining industry, and it's gone. Initially, it all flowed across into the bubble that was marijuana, and that exploded and disappeared. Now it's gone into tech and crypto, and previously it was in blockchain. And that money hasn't come back to fund us and move us forward, no matter how good our projects are and how much money we can generate if we get into production. And that's really the decision we made to stop drilling. Because we're raising money at a deficit to our valuation. We're drilling at a premium, and the market's valuing it at a percentage of that, 25%, 20% of what it costs to drill. So that's my comment on that. I can say I'm sorry to you, but I've walked the same path. And I expect I've got an awful lot more invested in than that shareholder does. And look, if it's part of your retirement, then I feel for you, but it's speculative industry. And perhaps if it's that big a risk, you maybe shouldn't have put it into mining. You should have put it into something very safe, because this is the industry that we're in, and it goes up and down, and we're in an incredible down, a very strange down that's very different to what we've seen before, because we're at all-time high gold prices. But we aren't seeing a lot of merger and acquisition. We're not seeing a lot of funding by majors and strategics, and most of the funds who invest in us have had a lot of redemptions, and they don't have capital to deploy either. So there is no money. And that's why Bralorne and Talisker has taken this path to transition across into production. Because ordinarily we would have just kept drilling. We would have converted our entire resource into indicated. We would have gone through the whole process to permit a large-scale feasibility operation. But we can't do any of that without money. Right, open to the next question.
So there was a second part to that, which was realizing that creating shareholder value lands slowly at the feet of the CEO. Is creating shareholder value top of mind for you as we ramp up production in 2025? Other than just the obvious digging for gold, what specific objectives do you have to increase share price this year?
Well, again, I've got to ask that retail shareholder if they've been paying attention. We're doing absolutely everything we can to create shareholder value by going into production and trying to produce gold at the all-time high gold price. So if that shareholder has a better recommendation for what they think we can do to create shareholder value, aside from what we're doing, please recommend it to me, and recommend it to the other 4,000 junior companies that are struggling to survive here. We're doing absolutely everything we can. And for you to even suggest that this is not on the top of my mind, I'm incredibly offended by that. Because if you think this is a lifestyle company, in 5 years, we've taken a project from 100,000 ounce resource, drilled 165,000 metres, raised the capital, built the team to go into production, then I'm incredibly offended by that. Next question.
With first gold production expected in Q2, are you able to give us a rough time frame of the window from material delivery to toll mill to payment receipt?
Sure. I think we covered that with the presentation earlier on. Was that clear enough to everyone, or?
I think so. Yeah. And then one last question, which was at what gold production run rate would you expect to announce commercial production at Bralorne? Would this be possible while still toll milling?
At this stage, I think it's around that 750 tonne per day mark. And, you know, I think we'd prefer to transition to our on-site mill there. Just because really the cost of trucking, the cost of getting someone else to mill, once we start to get economies of scale, the economics of having our own mill are much better. So to fully clarify that, I think about 750 tonnes per day is where the point is, and we'd certainly like to be transitioned away from trucking and off-site milling. Deborah, I might just show in the presentation here what the graphs look like for this production here. Hopefully you can see a sheet that says midterm production plan. So on the right-hand side, it'll show the ramp up, firstly in total tonnage mined per quarter, and then on the bottom here, development. It's mainly the top one that we want to look at. So really, when we hit that flat plateau up the top, which is in Q1 2028, that's when we're really at commercial production. Until then, we're still ramping up to that point, and that's about, on average, 750 tonnes per day. So that'll be about 2028, we'll hit that. Now, the investor may ask the next question relative to that is, why is it taking so long to get up to that commercial level of production when a lot of our development's already done? Well, it comes back to available capital and the fact that we're feeding our cash flow back into development. So down here in the bottom graph, we're slowly staging up this level of development to be able to sustain that longer term plan. So if markets were different and there was tons of capital, then we could bring that forward in the timeline. But at this stage, yeah, it's 3 years out.
And just looking at these final questions, I think most of these I can't ask you just because they're based on things that you can't answer.
Yeah, I might just make a comment on that. I've had quite a number of questions on webinars in general relative to our projected cash flow, what that's to look like, what the total number of ounces that we're putting out would be. At this stage, I've had a lot of arguments with our lawyers and also with the Securities Commission. We aren't allowed by law to put out what those projections are because of not having a fully fledged economic study, a feasibility study on the project. So the more astute of you can calculate what that is. You know what our average grade is. You know what the amount of tonnes that we'll be producing on a weekly, a monthly or a yearly basis are. So you can roughly calculate what that out is, knowing also what some of our costs are to produce. Then you can calculate roughly what it would be. Once we have cash flow and we've produced ounces and been paid for them, then of course we'll be reporting what those are. But it's just those restrictions from the SEC on what we can say at this stage of the project.
Got it. Okay, well, I think we can leave it there. Terry, thank you so much for taking all of the questions, as difficult as some of them might be to answer. I think we really appreciate your time, and I think investors really appreciate you taking the time to give an update and answer questions. If anyone has additional questions, feel free to reach out, or if you'd like a one-on-one meeting with Terry, we'd be happy to arrange that. Anything else from your perspective?
I'm just having a quick look here. There are some questions that we haven't answered on the chats here.
I thought I had to avoid the production and the cash cost ones.
Sure. There was one there on the grade of model and diluted grade. I just want to make clear to everyone that our our published grade in our 43-101 is diluted grade. So under the current changes, even inferred resources need to have reasonable prospects of extraction. So they've actually have been diluted with mining shapes. And also that continues on is how does that old grade production compare to our grades? Our grades are lower. Our mineable grades will be lower, simply because of the mining method that we're using. So a lot of the historic mining was shrinkage. So that's very precision. It's manual. Guys go in and they drill and blast very close to where the edge of the vein is. Our mining is a lot more mechanical. So we have a larger mining width. We're not as precise, so we have a bit of a dilution. So we see our grade come down. We're not expecting to be mining those 17, 18 grams historically, but we certainly expect to have something in the 10 to 12 gram per tonne range.
I don't think that any of these other questions can be answered. So anyway, yeah, thank you, Terry. Thank you, everyone, for participating. I will follow up with that one question on the short interest. And yeah, everyone, have a nice afternoon. Thanks for taking time while you're at site, Terry.
No problem. Thanks very much. And we'll try and make this a regular occurrence here, hopefully once a month or so, so we can keep everyone updated. A lot of changes happening here over the next few months. So happy to jump on and talk about it, and very appreciative that the internet held up for us. Thank you. And thanks for hosting, Deborah and Magda.
Thanks, Terry.
Thank you.